The best strategy for beginner traders equals stochastic plus price action combo. Alright, now that you've learned candlestick patterns and got familiar with the world of technical analysis, it's time to get practical. But here's the thing. When you look at the chart, the candles might not be so clear at first. You could even misread them, which leads to wrong analysis and losses. But today, we're going to explore a simple and profitable strategy together: price action and stochastic indicator. Price action means analyzing market movement using only price charts and candlestick patterns. Now, if we combine that with the stochastic indicator, we can spot our entry and exit points with great accuracy. Let's get into it. But before we do, don't forget to subscribe to the channel and smash that like button. Not weak traders, a home for every trader. First, a quick recap of the important candlesticks you learned in the last 2 episodes. Bullish candles like hammer, bullish engulfing, dragonfly doji, morning star, 3-line strike, bearish candles like evening star, 3 black crows, hanging man, shooting star, bearish engulfing. Now let's get into our combo strategy using stochastic and price action. Maybe it's the first time you're hearing about this indicator. Let me explain it simply, without making things complicated. The stochastic helps us know when the market is overbought, time to look for sell opportunities. When the market is oversold, time to look for buy opportunities. I won't get too technical. Just know that the indicator has 2 lines, % K line, % D line. When the stochastic is above 80, the market is overbought, so opening a sell trade can be profitable. When it's below 20, the market is oversold, so opening a buy trade can be profitable. So, when do we get a buy or sell signal? Whenever the % K line crosses above the % D line from below, we have a buy signal. Whenever the % K line crosses below the % D line from above, we have a sell signal. Let's now look at this indicator on the chart. Now let's check it out on TradingView. Go to Indicators, type Stochastic, and select the one by Everget. You'll see a chart appear at the bottom, but honestly, for a beginner, it might look confusing. Even for pro traders, it can be a bit much. So let's make it simpler. Go into Settings, click the Inputs. Set %K equals 14, set %D, and smoothing equals 3. Now a few tips based on time frames. Let's quickly go over how to adjust your stochastic settings based on the time frame you're trading in, because using the right settings makes a big difference. If you're trading on very short time frames like 1 to 5 minutes, you'll want faster signals, so set the %K to 5 or 9. This makes the indicator more sensitive and responsive to quick price moves. For medium time frames like 1 to 4 hours, a K of 12 or 14 usually works best. It gives you more balanced signals. Not too fast, not too slow, which helps avoid false alerts. Now, if you're working with longer time frames like daily or weekly charts, you need smoother, more stable signals. In that case, set %K to 21, and both %D and smoothing to 5. This reduces noise and helps you focus on major trend shifts. This indicator works more reliably on higher time frames. We only need 2 lines from the stochastic indicator: the %K line, which is usually blue, the %D line, which is usually red. You can hide everything else. We don't need the histogram, background, or even the middle level line. Keeping it simple makes everything much clearer and easier to follow. Let's take a look at XRP on the 1-hour chart. As you can see, the stochastic is sitting below the 20 level, between those 2 red horizontal lines. That means the market is oversold, or in simple terms, it's been sold too much, and it's probably a good time to start watching for a buy. But we don't jump in just yet. We wait until the blue K line crosses above the red D line from below, which happens right here. That gives us our buy signal. Then we wait just a bit more, until the stochastic moves above the 20 line, and the green line on the chart is touched or crossed. Once that happens, we're ready to enter the trade. You could even hold your trade as long as the stochastic doesn't drop deeply back into the oversold zone, below 20. Once it falls below the 20 level again, that would be a good time to close the trade and take your profit. Let's look at another example, this time on the Bitcoin 4-hour chart. As you can see, the stochastic is above the 80 level, which means the market has entered an overbought phase, or in simple terms, it has been bought too much too fast. This is when we start looking for potential short, sell opportunities. We only get a sell signal when the blue line %K crosses below the red line %D from above. That crossover tells us the momentum is shifting downward. I personally wait until the stochastic line drops back below the 80 level, and then I enter a sell trade, and boom, the price starts falling. But sometimes the stochastic indicator can give us false signals, or we just want to reduce our risk. That's exactly where price action comes in. And this is where candlestick patterns become super helpful. But let's be honest, as a beginner, it's easy to mix up candlestick patterns. I mean, telling the difference between a hammer, hanging man, inverted hammer, shooting star, or even a dragonfly doji can get pretty confusing. To be real with you, even I still get a bit lost sometimes with these patterns. The good news is, there's a way to make this a whole lot easier. We can use an indicator that automatically detects candlestick patterns for us. Alright, let's go back to the chart. Open the Indicators tab, search for the candlestick pattern indicator, and add it to your chart. Then go into the settings, and let's change the colors so it's easier to read. Hanging man, hammer, star, inverted hammer. And that's it. Now you've got a clean chart with patterns highlighted, making it way easier to spot key signals at a glance. Let's start with a live example on the XRP chart in the 1-hour time frame. The candlestick pattern indicator shows us an inverted hammer forming at the end of a downtrend, which often signals the beginning of a bullish reversal. But of course, just spotting an inverted hammer alone isn't enough to take a trade, so we bring in our stochastic indicator to confirm the signal. As you can see, right where the inverted hammer formed, the stochastic was in the oversold zone, below 20. And not only that, the blue K line crossed above the red D line, giving us a buy signal. That's when we enter the trade, and we place our stop loss just below the inverted hammer candle for safety. Now let's move on to the Bitcoin chart, also in the 1-hour time frame. Here, the indicator highlights a hanging man candle that appears at the end of an uptrend. Right after that, we also get a shooting star, which adds extra confirmation to the bearish signal. If you look at the stochastic indicator, you'll see that at the moment the hanging man formed, the stochastic was above 80, meaning the market was overbought. A perfect time to look for a potential sell setup. Then the blue line crosses below the red line, confirming a sell signal. And the fact that we got a shooting star candle right after makes the setup even stronger. So we open our sell trade right after the shooting star and set the stop loss just above that candle. Boom! You've got a clean, high-probability trade using a smart combo of price action plus stochastic. So there you have it, a powerful combo of stochastic and price action, and how you can even make it easier by using a helpful indicator to spot candle patterns. If you found this helpful, don't forget to hit that subscribe button, and if you'd like more videos on profitable indicator strategies, make sure to like this video so I know you're interested. See you in the next one. Happy trading!